the bearish view overall is definitely impacts your stock selection process and your overall decision making. In healthcare, we kind of do our own macro work to some extent that's focused more specifically in the sector. We've seen a lot of the similar things that the broader macro team has seen. But I think where you really see the most impact is on is really on the stock selection component.
Yeah. No, it's the same way in materials. I mean, in materials, like you're selling a lot of things that are used in the production process in other industries, and it's definitely if that begins to slow, if investment slows, the demand for raw materials slows, and these companies obviously lose on the top line, and then that flows through, and especially like the more with the move in the dollar and the kind of when you're in a deflationary environment, the companies that are kind of leveraged to inflation expectations get hit because you have this widening of spreads. It's harder for them to get credit, and then what they're selling also is going down, and that's kind of a feedback loop. So that most of the companies have been hit pretty hard.
Yeah, I mean same in retail, except I would say the one thing that's different is since mid-February when the retail sales number came out, you've seen a pretty big pop in the retail index. So the index that we typically look at is XRT, and I think it's up 15-20% since February.
Yeah. Well, it's the same in my sector. I mean, you have like this kind of unwinding of like short positioning, and it hurts.
Yeah, and you've seen kind of a lot of low quality companies pop up there. So
and then I know healthcare's kind of been underperforming because it's mostly been a cyclical rebound with energy and materials names, and kind of like you said, the names that have gotten beaten up the most, low quality guys are the ones that have rebounded.
In retail in particular, I mean, we're kind of interested in everything that affects the consumer. So, I mean, you start retail sales, you get that every month. And then, consumer credit, employment, wage growth. I mean, there's a few different factors that affect retailers from, both a demand perspective and a cost perspective on the P&L. So, I mean, it's something we're looking at the consumer balance sheet every month and just seeing how that's trending. And it gives you kind of a little bit of a leading indicator as to what's going on out there.
Yeah, I mean in healthcare, a lot of it's employment based, so it's really trying to get at admissions and what utilization trends are doing. Because obviously, if you can get an edge on that, then you get an edge on the stocks. And so we look at a bunch of different things like JOLTS, for example, that was released. That tends to have a really high correlation to hospital same-store admissions, employment trends in general, hospital employment, healthcare employment. Things like, even like all the PPI and PCE series for hospitals, like they have a med lab series for PPI, and that tracks really well to like Quest Diagnostics, adjusted volume trends and pricing trends. So, we tend to try to look at all the publicly available data sources that we can to see what impacts the stocks, and then at the same time kind of frame that up in a larger macro view.
Yeah, it's the same. It's the same in materials, and a lot of it's based on inflation expectations. You have companies that are selling commodities; their input costs are commodities. Sure, there's a difference that not all commodities and input costs are correlated. So you kind of have to try to find those differences and figure out which driver is going to work in a deflationary environment. But it's like the early cycle stuff: construction spending, fixed investment growth, and then definitely inflation expectations.
Yeah. And then another one too is, for us at least, is per capita consumption. So any type of metric on that basis, like the whole ACA taper theme, it's like if you look at historical Medicaid outlays on the Medicaid population, and if that number goes up, that means that people are utilizing more healthcare. So that's another series that we tend to find pretty useful as well.
The one thing on retail too is a little bit different from you guys is we got a lot of small guys. So a lot of little specialty retailers, smaller brands where there's a lot more volatility. So I mean, you can look at macro data for the big guys like Walmart and Target, and you can kind of map out how things are trending over a longer duration. But there's going to be a winner and loser every quarter, and things will whip around a little bit more.
Yeah, that makes sense.
It's more of a bottoms up when you get into those types of situations.
Yeah. It's always the struggle, right? Because you can have like a really good fundamental case, but then the macro is either going against you or kind of telling you a different story. So at least in healthcare, the way we run our process is we have a broader macro theme that we, deflation, ACA taper, increased use of technology, which kind of perpetuates the whole, deflationary cycle. And so then we basically pick stocks out of that framework, obviously using fundamental screens, what have you. So we do try to balance it as much as possible, but it's not always the easiest, especially if you think about it from a style factor perspective. You know, for example, we really like Athena, but it's a high beta stock. And, in a volatile market where beta is not rewarded, it's tough because, they could sustain growth. It could be a great fundamental story, but, from a style factor and the macro perspective, it could, it makes it more difficult being long.
Yeah.
A name like that, though you have a great fundamental story.
Yeah, it's the same way in our sector. We're kind of top down and cycle oriented, and top down from a macro perspective, from a business cycle perspective, and then kind of long term fundamental from like a fixed asset investment perspective. So we believe in like these long commodity super cycles, and we try to match those up. So we figure out what's going on in macro, and then from there back into from a fundamental perspective, look at individual companies and figure out which ones kind of fit into that framework. And you have to have the style factors right, because you can see what happens with some of the names recently that have been really leveraged to inflation expectations and have a lot of debt, aren't hedged as well, or high beta or small cap stocks. They've really outperformed, and if you're on the wrong side of that, you can definitely get crushed.
For us in retail, counter cyclicals, you got to think dollar stores. People can't afford Walmart, they go to Dollar Tree or whatever it is. So that's pretty much the counter-cyclical one for us. Pretty obvious, but that's what it is.
Yeah, in healthcare, it's typically a defensive sector. I think we're currently experiencing a dynamic with stimulus where we're coming out the other side of that, so it's less defensive than I think it would normally be as we kind of mean revert. But in a down kind of on a weak or recessionary environment, I think healthcare does better. If you just go back and look at all the historical consumption metrics, PCE, earnings, revenue growth, whatever, it never really diverges. It's a pretty steady state, and it's really hard to kill a healthcare company. So as a broad sector, could you be long it if you think that the rest of the economy is going down? Sure. I think we saw that with the collapse in energy and industrials, right? That we saw in the last 6 to 9 months, where even though healthcare in an absolute sense was down relative to those sectors, it held in there just because you're not going to see the same type of volatility because it's healthcare. But a recessionary type environment does impact healthcare, just I think in a different way that would impact retail or materials or something like that.
Yeah, my sector is very, very macro driven. I think you have to find the companies that, for example, Agrium's a fertilizer company. They have a huge part of their top line is nitrogen production, ammonia fertilizer. Pretty inelastic demand story. People have to put it on, farmers have to put it on crops every year. And the biggest cost input is nat gas. So now you have, over the last 5 years, you have nat gas prices that have gone, continue to get crushed. There's kind of this availability of cheap North American nat gas now. We're still a net importer of nitrogen, so we can, there's a market share story there. So it's their top line's not as volatile, but the input costs are just plummeting. It's 80% of input costs is nat gas.
Yeah.
So you kind of try to find those stories, the stories where they kind of get some margin expansion from lower commodity prices.